The broadcast is now starting. All attendees are in listen-only mode.
Good morning. Welcome to the CFRA Investment Outlook. Should investors keep calm and carry on? With today's webinar, you can see on the right the handout so you can access the presentation afterwards. With me today, we're delighted to have Sam Stovall, the Chief Investment Strategist at CFRA, Stu Glickman, Energy Equity Analyst, and Todd Rosenbluth, who heads up our ETF and mutual fund research. Next. CFRA is the leading independent research firm. We have over 75 professionals covering industry sectors, and CFRA's history goes back many years. Milestone certainly was October 2016, when the leading forensic accounting firm CFRA acquired S&P Equity and Fund Research. More recently, last year, we acquired the ETF First Bridge Data, and today we are looked upon for our independence. Next, please. As everyone is looking at our proprietary methodology and the different areas we cover and our published output, I want to take a moment just to talk about coronavirus or COVID-19, which brings uncertainty, obviously, to the global economic and financial industry. CFRA's analysts and strategists remain focused on delivering exceptional research insights to help investors stay up to date on the latest market developments during these unprecedented and turbulent times. Volatility has been a chief concern for investors in recent days, and CFRA's focus on risk mitigation makes our research a valuable resource. In addition, we provide great thematic research on MarketScope Advisor, publishing around coronavirus. You'll see on our homepage all the research that we continue to be doing on markets, on industries with coronavirus. And we also deliver weekly market commentary, sector insights, and portfolio guidance. So we have, that is CFRA, a history of pioneering research in forensic accounting and our legacy of analytical rigor that we then integrate with our fundamental equity research methodology. Next slide, please. So this is the recent investors ranking showing that CFRA is #1 on the basis of performance. So it's not only our quality and depth of research, but it's also our performance, where we are in the #1 position for 1 year and 3-month trailing average for firms covering more than 900 stocks as of March 20th, 2020. I would also want to point out that we use our fundamental equity research into CFRA's ETF and mutual fund research methodology and ranking system, which is forward-looking, unique in that respect, while other research and ranking systems are not. And through a machine learning model, we've examined the underlying holdings of funds, the fundamental research, forensic accounting, valuation, and risk metrics, because many of you are investing through ETFs and funds. And also, we look at the risk side, looking at subcategories for our methodology on cost, risk, and reward. When you have a chance, take a look at it on MarketScope Advisor. If you're not familiar, we're really excited with the rigor that we've put into our methodology. Next, please. Most important, and what I'm so excited to be at CFRA, is that all of our resources are spent on one thing, and that's our independence of research. Research is all that we do, and it's our ability to be free of conflicts while other competitors are not. And with that, we hope we provide integrity and confidence in the research that we provide for you to make better investment decisions. So with that, let me move to the next slide. We want to move to Sam Stovall, who will speak about the equity outlook for the year ahead and the coronavirus. Sam, good morning.
Good morning, Ken, and good morning, everybody. Thank you for tuning in. Kessie, let's take a look at the first slide, really talking about what are the headwinds and the tailwinds that investors have to deal with today. We established our 12-month target back in December of 2019 at 34.35, thinking like most people we would see, a mid to high single-digit price appreciation for all of 2020. We are maintaining our 12-month price target. It's just that we are extending it out to where we are a year from now. Our belief is that in general, we will probably end up seeing maybe a V or a U-shaped recovery, but obviously a lot will depend on how long the corona crisis continues. We have an awful lot of headwinds out there, uncertainty surrounding the magnitude globally of this virus. We saw last month with the unemployment rate going from 3.5% up to 4.4%, skyrocketing unemployment. But actually, March is expected to be fairly tame when compared with the April data. Action Economics is forecasting that non-farm payrolls will fall by 11 million in April, and that we will actually see the unemployment rate skyrocket to 10.6%. We've been seeing the stock market advance over the last couple of days. I think it's because investors are looking beyond the valley. However, the problem is that the valley continues to widen and deepen if you look to economic growth projections as well as earnings forecasts. And so as a result, nobody really knows for sure how deep this recession will go and how long the earnings recession will last. Also, we've had negative indicators. The market was down in January, in February, and in March. That happened 6 prior times since World War II. And in those 6 prior times, the market averaged a full year decline of close to 15%, and it rose in only one of those 6 observations. However, we have things working for us at this point. We have unprecedented fiscal and monetary stimulus that not only has been injected into the marketplace, but is likely to continue as more stimulus bills are discussed and voted upon in Congress. We have been seeing some relaxed regulations as it relates to particular industries. Maybe we'll even see some trading restrictions be reinstated, such as the uptick rule, et cetera. But I think a lot of investors can agree that we had some very attractive valuations take place in this marketplace at the most recent market bottom. So Kessie, let's take a look at the next slide. The traditional sector rotation during bear markets was seen with the February 19th top down to the March 23rd low. There's an old saying that when the going gets tough, the tough go eating, smoking, and drinking, and if they overdo it, they have to go to the doctor. So not surprisingly, consumer staples and healthcare tend to be among the better performers. And I guess misery loves company, so people like to communicate with each other to tell them how bad they feel. Whereas the more cyclical sectors, industrials, financials, energy, tend to be among the worst performers. Compare that to the right-hand table, which shows the average sub-industry performances brought up to the sector level since World War II. And again, you find that in general, it's the sectors where the demand for the products and services remains fairly static that hold up well. One exception this time around was utilities. You could also say real estate, because those groups had been bid up so much because interest rates were so low. Investors were looking upon real estate and utilities as bond proxies, and therefore had been buying into them, and they were very quick to bail out once the market exhibited the glide path of a crowbar. Next slide, please. So right now we have overweight recommended staples, healthcare, and technology. This has bear market. It's been one that's geared more toward the consumer discretionary real estate areas, but we also have an underweight recommendation not only on discretionary, as you can see in red on the bottom, but also on utilities because of its excessive relative PE ratio. In the center of this slide, we see CFRA's ETF ranking, and that is something that Todd Rosenbluth will be discussing, but I'll give you a hint. It's basically a compilation, a lot of sentiment, fundamental data that can prove invaluable when looking forward as to an ETF's performance possibilities. Let's take a look at the next slide, and we see when I talk about this valley that investors seem to be looking across, how it continues to deepen and widen. On January 14th of this year, before the first case of coronavirus was reported in the US, the world was expected to grow by 3.3%. Advanced economies up 1.7, emerging markets up 4.4, the US even up 2.3%, and on the very bottom we see China expected to rise 5.7% in real GDP. However, as of yesterday, now global GDP is expected to be up only 1%, advanced economies off 1.5%, emerging markets still in positive territory, but dramatically lower from where they were. The US most definitely in recession along with Europe and Japan, and China's growth rate likely to be cut in half. And those numbers continue to erode as time progresses. If we dive a little bit deeper in the next slide, what we find is that our economists are saying on a quarterly basis, the blue is what the expectation was on January 14th. The orange is where we expect things to be right now. These numbers have been falling ever since the middle of January, but what has been consistent is that our economists are projecting a V-shaped recovery, where about a 1% decline in the first quarter, 14% decline in the second quarter, followed by a 10% surge in real GDP in the third quarter, and then a 6% follow through in the fourth quarter. For all of this year, the entire year is likely to be down close to 1%. However, 2021 is expected to be higher by almost 4%. So our economists are pretty optimistic about where they see the US economy headed. In the next slide, however, we can see that Wall Street analysts are not as optimistic about corporate profits. At the beginning of this year, expectations were that the S&P would show an increase of almost 8%, with almost no sectors showing negative numbers, not only for the full year, but also for the individual quarters. However, this data based on yesterday's compilation of S&P Capital IQ consensus estimates shows that a majority of the quarterly and annual numbers are now in the red, with the full year being off 8.3% and the first three quarters showing negative returns, with the second quarter being down the deepest, about 18%, and fourth quarter barely eking its head above positive territory. The real question is, will we end up with 4 quarters that are in negative territory once all is said and done? So from an earnings perspective, it looks as if we have some tough sledding ahead. And now with the first quarter reporting period likely to begin in earnest in the beginning of next week, that we're probably going to get either weak guidance or an absence of guidance, because companies just don't know what to expect for the coming quarters. And so I think that will throw some additional uncertainty toward investors. However, when you hear strategists talk about this being a rare opportunity in terms of valuations, if we take a look at the next slide, we can see how true these statements are. This is a table showing the 11 sectors in the S&P 500, along with the growth and value styles, showing what is the current PE ratio based on forward 12-month expectations. What is the average going back 20 years, and whether this sector is trading at a premium or a discount to its own average PE ratio. And we can see financials, healthcare, industrials, tech, materials, real estate in double-digit discount territory along with the S&P 500 back on March 23rd. Looking on a relative basis, or the PE as compared with the S&P 500, we also see financials, healthcare, and industrials in negative territory, meaning double-digit discount to their relative PE. Yet we find that consumer discretionary and utilities double-digit premiums. And what was interesting was that just recently we had energy, which had been trading at a sharp discount to its long-term or to its forward 12-month PE ratio, now flip around because the price of oil dropped so dramatically. So what we're saying basically with this slide is that, yes, there were an awful lot of investment opportunities that were presented to investors. So what are some of those opportunities today? Well, Kessie, let's look at my final slide, which is simply a screen that I performed on MarketScope Advisor. What I did was I asked, okay, show me those stocks that have buy or strong buy recommendations by CFRA equity analysts. But I only want to look at quality. Show me those companies ranked A or A plus that basically are superior in terms of their consistency of raising earnings and dividends in each of the last 10 years, according to the S&P Global Market Intelligence quality ranking. I'm a little bit greedy. Give me a dividend yield that's equal to the market or higher, but at the same time, I want a cushion in case the earnings come down for these companies. So show me all those companies that have a payout ratio of less than 75%. And then what I did was within the stars rankings, I sorted high to low in terms of target price differential. So where are the greatest price appreciation opportunities? And what I show here are about 18 stocks that fit these criteria. So this is just an example of the kind of screening that you can do on MarketScope Advisor, looking for those stocks that you feel have great investment merit in the months ahead. With that, I will then pass it on over to Stuart, who will talk about the energy sector.
Thank you, Sam. Good morning, everyone. So my talk today is where are the foxholes in an oil route? And basically what I'm saying is this is the kind of market for energy where you want to be playing defense. I am not optimistic on the outlook for energy, and so you really have to pick your spots where you want to focus. Okay, so agenda. We're going to walk through what just happened in crude oil prices, a little bit of time to spend on the energy value chain, how to think about the industry from upstream all the way down to downstream, upstream capex, where that is likely to head, and then playing defense. So what just happened in crude oil? You had simultaneous shocks to the system. You had a demand shock starting in January when coronavirus spirals out of control, supply shock, which happened starting in late February and kind of culminated in early March when Saudi Arabia and Russia walked away from the negotiating table. WTI prices, WTI is the US benchmark for crude oil, West Texas Intermediate. They collapsed because of these simultaneous shocks. The last time that we had two shocks like this happen at the same time was almost 100 years ago. So now you've got US oil companies caught in the crossfire. And when oil prices are in the 20s, most firms are not breaking even on new wells. Just a little bit on benchmark prices. They kind of fell slowly at first, but then all at once. You can see drifting down from December through January through February. But even in February, you know, $45 a barrel for WTI, about $51 for the European benchmark Brent. And then the March 6th meeting happened with Russia and Saudi Arabia with no deal. And then here we are. WTI fell as low as $20 a barrel. Brent fell to about 25. They've come off the bottom a little bit. So WTI today is around 27. Brent is around 32. Qualitatively, that's nice, but it's really still very poor in historical context. Let's take a look at oil demand. The overall market for oil is in a steady state, normal market, around 100 million barrels a day. And every year, the change in global oil demand is going to be somewhere between 1 and 2 million barrels a day. In January, the 2020 outlook was for plus 1.2 million barrels a day of incremental global demand, which is pretty normal. February, it started to drift down a little bit, and then in March, it really tailed off. I expect that things are going to look even worse in April. The amount of demand destruction that occurred in March is going to be massive. Now look at OPEC Plus. OPEC Plus consists of your 14 OPEC nations plus a handful of other non-OPEC companies, countries, especially Russia being the most important. And you can see that with the blue bars, Saudi Arabia, they've been doing more than their share of heavy lifting in keeping oil production down, but that's changing effective April 1st. Starting on April 1, Saudi Arabia really opened the taps, and now they're ramping up about 2.3 million barrels a day, up to around 12. Russia never really cut that much to begin with, but they're adding on as well. And so you can see why oil prices fell as much as they did. So where do crude prices go from here? If you look at the estimates from the Energy Information Administration, they're calling for $38 a barrel for WTI in 2020, about $50 a barrel in 2021. I would caution you, however, that these estimates were written as of about March 11th. A lot has happened since then. I would expect that the next update from the EIA is going to point to prices that are going to be considerably lower. I would expect something closer to $30 a barrel in 2020. Now let's look at the value chain. The section on the left is where I think you should start. First, we start with upstream. Upstream are the folks that own the oil and gas in the ground. Energy services are the ones that help the upstream guys get the oil and gas out of the ground. Once you have it, you have to send it somewhere. That gets you to midstream. It's the pipelines that send those barrels of crude oil from location A to location B. And then finally, you get to downstream, which are the refineries, where you take that crude product and turn that into refined products that you and I can use, like gasoline or jet fuel or heating oil and so on. If you look at it from a fundamental perspective, supply and demand, I am negative almost across the board right now, across the 6 different sub-industries in energy. The only one where I'm making an exception is oil and gas midstream, where I'm neutral. The value chain, everything starts with upstream. Higher levels of upstream CapEx breed higher needs at other parts of the food chain. These tend to be fairly long cycles. Upstream CapEx was extremely high between 2004 and 2014. We've been in a declining upstream CapEx cycle starting in 2015. It doesn't look like it's changing anytime soon. Now a little bit more on upstream CapEx. So where do upstream CapEx dollars go? A lot of it is for development spending. You're trying to take those known reserves under the ground and turn them into production. Technology has really done a great job at providing what I call a free lunch to producers. You get greater production even with lower CapEx. A 2020 recession is going to make the situation worse. E&Ps are likely cutting their CapEx about 30%. We just had news today, actually, that ExxonMobil is adjusting downwards their CapEx spend for 2020 by 30% as well. And if the largest firm in the industry is doing that, you know that there's a problem. Just a quick look at Chevron in orange and Exxon in blue. You can see that even though these are integrated companies, the lion's share of their spending is coming from upstream, somewhere between 70 and 80%. And what I want to point out here is the high point reached in 2014. You can see that if you combine the integrated spending as well as the E&P CapEx spending, they were spending north of $300 billion in 2014. We are nowhere close to that today, and it looks like it's going to be drifting down again. Capital spending budgets, again, are being pared back both for the E&Ps in blue and the integrateds in orange. The lack of spending is going to eventually weigh on production. Maybe not this year, but eventually it's going to weigh on production. Okay, so if we don't like virtually any space in energy, but you still want to own some exposure to energy, how do you play defense? Where are the safest places? I think there's a couple things you have to think about when you're thinking about energy companies. The first is you need to be patient, because this recovery is probably going to be slow. So you want to avoid companies that already were in trouble before this rout began. When you think about the different financial statements that all of these companies put out, you really want to focus on the balance sheet, not earnings. If cash is king, then good access to capital markets is queen. When it comes to dividends, I think it's important to choose stability over size. And lastly, I would avoid energy services entirely. That lack of CapEx coming from the upstream, that's the revenue stream for energy services. So if the upstream guys aren't spending, the energy services folks are not making money, are just not making money. So this is a chart that shows debt to EBITDA ratios that as of year end 2019, the lower the ratio, the better. You can see that the drillers on the far right were already in trouble even before this oil rout began. Midstream names tend to be a little higher anyway, but not onerously so. And you can see that the integrateds and the refiners are doing better than virtually everybody else. 2019 interest coverage ratios. Here, what you want to see is a higher ratio, of course, EBITDA relative to interest expense. What's noteworthy to me here is that the E&Ps are actually relatively low when it comes to debt servicing, and so we're gonna elaborate on that a little bit in the next slide. So here, what I do is I take all the E&Ps in our stars coverage universe and break them out between the ones that are oil directed, meaning that that's what they're aiming for is the oil under the ground, versus the ones that are gas directed. So, for example, the folks in the Marcellus Shale in Pennsylvania who are really going after dry natural gas. And what you can see here is that the best interest coverage ratios show up first among the oil directed in general, but particularly the large ones. The larger the firms, the better the balance sheets, the better the interest coverage is. Those firms are going to have a better time or an easier time of surviving this meltdown in energy. So this oil crisis has caused havoc pretty much across the board, but there are different effects on different sub-industries. First, let's start with the E&Ps on the left. If you didn't walk into this oil route with hedges on, your unhedged production is going to suffer. Some E&Ps actually engaged in hedges that are known as three-way collars. That's a dangerous place to be when oil prices collapse the way they did. And in those cases, three-way collars are actually worse than no hedges at all. CapEx budgets are getting slashed, so production growth is going to dissipate. It's going to dissipate particularly in 2021. And you have to pay attention to dividend payout ratios, especially for the firms that do, obviously for the firms that do pay dividends. On the midstream side, they tend to be better insulated from this kind of weakness than most sub-industries, but they're still going to be affected to the degree that a midstream firm has what's called fee-based business, meaning it's kind of like a toll booth for the industry. They should hold up better. But if you do have volume risk, then volumes are likely to dry up, especially if E&Ps start to shut in wells. And any midstream firms that have work that's called percent of proceeds, the value of that work is going to be really decimated. Lastly, on the integrated side, they're called integrated oil companies because they have both ends of the value chain. They have the upstream on the one hand and they have the downstream on the other hand. Normally, that's seen as having a diversification benefit, but the benefits of that are eroded when both ends of the spectrum have fundamental weakness. Upstream CapEx budgets are getting slashed, free cash flow is going to go down, and all the major integrated oils, their number one goal and their number two and their number three goal is just protect the dividend. This is just a quick look at rig counts. Rig counts down 22% from the peak. That's only through February. When we get the March data and April data, it's going to be far down from that. This is just a view of what oil prices have done to energy bond prices. So if you were thinking about trying to raise capital from fixed income investors, you can see that the current yields in blue are actually fairly tight correlation with West Texas Intermediate oil prices in orange. And because of the plummeting oil price, current yields on bonds have gone sky high. And I think it's just a reflection of how difficult it's going to be if you're trying to raise financing. You would rather be in a position where you already had your financing in place and don't need new financing. This is a look at E&Ps that do pay a dividend. The blue bars, I think, are relatively safe for 2020. The orange bars, I think you need additional view has to go into those to see whether or not you think those are at risk. I would say the ones that are on the negative side, meaning below 0% here on the left-hand side of this chart, those are the ones that I think have the biggest risk of facing dividend cuts. I would point out that Oxy and Apache both already have cut their dividends at least 80%, if not more. Integrated oils. High payout ratios are leading to higher debt. You can see on the left-hand side here, Exxon in blue, Chevron in orange. Dividend payout ratios had been fairly low, close to a decade ago. They've started to rise, both for Exxon and Chevron. The difference here, if you go to the chart on the right, total debt, Exxon again in blue, Chevron in orange. Exxon's total debt has been rising. Chevron's has actually come down. Exxon's budget has historically been a little more aggressive with more spending on longer term stuff. And I think that's why I think that's why it's a less compelling investment. We just upgraded Exxon today to a hold from a sell after they slashed their CapEx budget as much as they did, but we still have a buy opinion on Chevron. Both Exxon and Chevron, when it comes to protecting their dividends, they do have one sort of hidden quiver in their arsenal, which is their balance sheets were, as of year end 2019, were in very good shape. Net debt to capital ratios for Exxon in blue, Chevron in orange, both around the 10 to 11% range. When you go to the chart on the right, the free cash flow outlook for Chevron is relatively better, but given that the balance sheet for Exxon is still in very good shape, if they wanted to tap the balance sheet to borrow to continue to fund the dividend, because that dividend eats about $15 billion a year, they could probably do so. So I think they are going to maintain their dividend. Some upstream energy picks in an oil route. Start with Chevron. We have a 4 stars or buy opinion on them. They have excellent free cash flow generation. As I mentioned, their debt levels are very low. Compared to Exxon, they have better operating metrics. That didn't used to be the case, but Chevron has done a very good job in the last couple of years of streamlining their cost base, and now they're outperforming on a per barrel basis, in my opinion. Cabot Oil and Gas, ticker COG, also a 4 stars name. This is a pure play in natural gas. If you want to be insulated from oil price weakness, this is probably the purest play that I can suggest, because everything they do is about getting natural gas out of the Marcellus Shale. They also have lower than average debt levels, not quite as good as Chevron, but still good. And then lastly, EOG Resources, ticker EOG, also a 4 stars. They have a conservative management team. Their debt levels are very low, and they do a very good job at reserve replacement. Now let's talk about midstream energy. This oil crisis means that midstream is exposed too. Now, under normal circumstances, midstream energy would be a great place to hide. However, crude prices in the 20s is not normal. When folks talk about midstream firms and valuation, often you look at a metric called the distribution coverage ratio. That is useful to a point, but when you value midstream firms in this way, it presumes that credit market access is uninterrupted. I think a better test for midstream capital allocation is cash from operations. This, on the other hand, presumes that capital market access is constricted. And given where oil prices are, I think it's a safer bet to say that capital markets are constricted. As with other spaces, you want to view relatively high dividend yields with a fair bit of suspicion. If it's too high, does the firm have a balance sheet it can lean on? So here's a look at distribution coverage ratio. You want this ratio to be north of 100%. And if you look at the estimates for 2020 and 2021, you'd think, oh, okay, north of 160%, that seems like an awful lot of margin of safety. However, it looks different when you factor in growth CapEx, because the previous slide on distribution coverage ratio does not include growth CapEx. Here, what I'm saying is, let's take the average firm and look at their cash from operations and scale that by the combination of either distributions, meaning dividends on the one hand, or growth CapEx on the other hand, because those are the two major decisions that any midstream firm has. And you can see that because this ratio was below 100% for most of the time, what that means is that to the degree that their cash from operations is falling short, they are supplementing it with external capital. The ability to supplement today is going to be more onerous than it would have been, say, even 4 months ago. And so what you want to see is firms that have that ratio closer to 100% or higher. The median firm in midstream is going to be a little bit below average, a little bit below 100% in 2020, and almost neutral in 2021. So some midstream energy picks that we like in an oil route. Obviously, they still have risks, but we still like these names. Magellan Midstream Partners, it's refined products driven. Certainly, refined product demand is going to be weak in the first half of this year. However, they do have an attractive storage business, and because of the way oil prices have fallen, a lot of firms are quite reasonably saying they would rather, hang on to the oil and sell it at a future date when oil prices are better. And Magellan has a way of playing that with their storage business. Their yield is north of 12%, which obviously is attractive. Kinder Morgan, ticker KMI, also a 4-stars name, largely natural gas driven. Its debt metrics are below peers, which is nice. And it is able to self-fund its growth capex as well as its distributions just with operating cash flow. Lastly, Enterprise Product Partners, ticker EPD. This is a natural gas liquids focused name. Its operating cash flow should cover almost all of its major outlays in 2020, and it has a yield of almost 13%. And now with that, I will turn it over to Todd.
Thanks, Stu. And we'll transition back for my colleagues to take control of the slides. I'm going to cover ETFs. I head up the ETF and mutual fund research here at CFRA, and we're going to cover some of the things that Sam and Stu talked about, specifically to sectors and specifically to energy. But I also want to talk about ETFs and how they have done. There's been a lot of fear mongering, a lot of concerns given how much money has gone into ETFs in the last 3 or 5 years, that they would be the cause of a market sell-off, that investors would not be able to get out. And so, and often the message has been they haven't had a chance to be tested in a real world environment with the amount of assets that are there. So we now have that. And so as we move to the next slide here, you'll see just how ETFs have done. I'm looking at the first quarter, or almost for the full first quarter, the data that's here. And you can see the blue bar being year to date, and then the orange bar being just the month, or the trailing 30 days through almost the end of March. You can see a lot of money went into not only equity ETFs and commodity ETFs throughout this year, but in particular in March. While the stock market was falling and fell into a bear market, we've seen demand for equity ETFs. We've seen some of the flows that went into fixed income ETFs in the fourth quarter, which was very strong. And 2019 was a record year for fixed income ETFs. I've been on prior presentations talking about that. It's been slower for the year, and we've actually seen outflows to fixed income ETFs during the last month or so. But let's dig a little bit deeper as we move to the next slide here, being able to see what's been happening. Specifically equity ETFs. Now, there's been concerns that as investors would sell out of equity ETFs, that would cause the stock market to end up falling. The reality is equity ETFs own a mid-single-digit percentage of the underlying stocks inside the S&P 500. And while we hit a bear market and we were down double digits for the month of March, 2 of the S&P 500-based ETFs, SPY and VOO, were among the biggest inflows. Combined, they had about $18 billion of net money going in to these products. But it just wasn't S&P 500 equity ETFs. We saw total market index products like VTI and ITOT, that includes some small and mid-cap stocks, and then specifically small cap stocks tied to the Russell 2000 with IWM seeing inflows. So we're saying the ETF tail is not wagging the dog. I have a dog at home. You hopefully don't hear her as this webinar will take place. But it's not the tail that's doing it. The dog is making the decisions themselves. The underlying stocks inside the ETF are driving the market lower, not the ETF itself. Let's move to the next slide here to just talk about fixed income and to take a phrase that Sam mentioned earlier about when the going gets tough. Not only do they go smoking and drinking and then have to head to the doctor, but they also turn to ETFs. We saw record volumes taking place in March. Nearly $35 billion of trading volumes went to U.S. bond ETFs in the month of March. If you think about it on a monthly basis, that's $11 billion. It's a triple the amount of volume. Investors were rotating in and using the liquidity of fixed income ETFs as a net advantage for them. Specifically, high yield, and there's been concerns that there's too much money in high yield ETFs. When investors would look to sell or would look to trade in those ETFs, they wouldn't be able to execute those trades. That's not what happened. We saw more than a doubling in high yield bond market trading being represented by HYG, the flagship iShares high yield bond ETF. HYG gets a lot of attention in part for its liquidity, in part for its relative size, but people tend to focus on that it is exposed to energy. And yes, relative to the S&P 500, an 8% weighting in energy is relatively high, given that's more than double what it is in the S&P 500. But it's important to know what's also inside. You've got a quarter of the assets in communication services companies, cell phone companies in particular, 16% into what is referred to by iShares as consumer non-cyclical. You can think of that as the consumer staples companies. And HYG has more than half of its assets in double B rated bonds. So you certainly are taking on some credit risk and more credit risk in HYG than you would in an investment grade corporate bond ETF. But this is not loaded with companies that are about to default. Obviously, companies could get downgraded lower, but that isn't the cause of it. Let's move to the next slide here. Ken touched on this earlier about CFRA's new rating methodology. We launched an upgrade of our ETF rating methodology in the month of March. Tomorrow, we will be upgrading our mutual fund research methodology. So thanks for tuning in. You get a sneak peek about that more closely. We're doing what we've been doing beforehand. We're looking inside the portfolio. We're attempting to be more forward-looking in our metrics, not just relying on past performance, but tapping into our equity and accounting analysts to help us with future predictions about the underlying companies. But what we've added in are a couple of things, one that Ken touched on and one that he didn't have the chance to do so. We're focusing on machine learning techniques, so our model gets smarter month after month based on what's going on in the underlying markets, and we certainly have seen April or March be more volatile than February, and then April is shifting, and we're starting to see a bit of a recovery. And then we're also blending in additional metrics tied to CFRA's expertise. Forensic accounting work, looking at the underlying companies from an earnings quality perspective, much better than we did beforehand, so that we're not just relying on a couple of forward-looking valuation metrics. We also are taking risk into account. On the next slide here, you'll get a little bit more color about the overall approach. On the left-hand side, I want to just draw your attention to how we're doing this. ETFs now are rated with a star rating. They previously had an overweight, market weight, or underweight rating. And we are using cost, reward, and risk. So a higher score for reward, as you see here, is a higher reward. This was the metric Sam was showing earlier regarding the sector allocations he had earlier. Risk, in this case, a low score is not favorable. It means it's riskier. And in this case, a low cost score is not favorable. It means that the ETF is relatively expensive. And I won't spend too much time on this in the interest of time, but you'll have the copy of the slide deck to have more about our ETF and our mutual fund rating methodology and what makes them different from one another. But I do want to give a couple of examples of commentary on the next slide, if we can move to it, please, about CFRA's views and some recent content. Stu spent a lot of time appropriately on energy and the dividends. Ken talked about how we were talking about COVID-19 across a number of different industries and sub-industries. There's a great report you can find on MarketScope Advisor that our equity research team puts together, highlighting that they were negative on parts of the consumer discretionary sector like hotels, restaurants, cruise lines, and resorts. Stu talked about the energy space. We're positive on many of the healthcare areas, specifically biotech and pharmaceuticals. The right-hand side, I wanted to just show you that these are three different dividend ETFs. The first one is from First Trust. The second is from iShares. The third one, DGRO, again, has more of a dividend growth focus. And you can see the devil is in the details when you look at the sector exposure across just those three sectors. DGRO has more healthcare exposure than FVD and also more consumer discretionary, and is about the same in energy. Energy is heavily weighted within HDV. And so if you were hearing Stuart's talk and concerned about the dividend weighting, dividend risks out there for energy companies, HDV may be something to be more mindful of. And then lastly, I wanted to highlight the consumer on the next slide, if we can, the consumer staples sector, and one of the ETFs tied to that space, KXI. This is our focus ETF of the month of April. It's from iShares. It's a global play. So not only do you have U.S. companies that we at CFRA like, such as Coke and Pepsi, Costco and Walmart, but you get a blend of international companies. British American Tobacco, Diageo, and Nestle are some of those larger holdings. And you can see more about how the ETF is broken down across various industries on the right-hand side. And so with that, Ken, as we move to the next slide, I'll bring it to you for us to take as many questions as we have time. Thanks.
Thanks, Todd. And also remind everyone that Todd is regularly putting out great thematic research on ETFs and fund research on MarketScope Advisor. So now let's move to Q&A. And Sam, Americans are an optimistic people, and the question is, if the S&P 500 is 20% above the March 23 low, can we say we're in a new bull market?
Well, Ken, I think that we are in a new bull market with an asterisk. I say it because here at CFRA, we say that a new bull market starts when the market has risen by 20% or more off of the prior low. Yet I think there needs to be time frame attached to that. So what we do is we attach a 6-month time frame, implying that yes, we could say that we're in a new bull market right now. However, it has to be sustained for 6 months before we can honestly say that it is a new bull cycle. The reason being, every mega meltdown bear market since World War II has had at least one 20% head fake. Case in point, in 2008, the market bottomed on November 20th, down 52% from the October 2007 high. We then rallied by 25% into early January of 2009, only to then fall and set an even lower low with the S&P off 57% on March 9th of 2009. So the bull market did not then become a new bear market that lasted only 2 months. What it basically indicated was that we had a very short-term oversold condition that traders took advantage of, yet the bear market had not fully been shaken out. So we could be in that kind of a scenario this time where we are in what I had said before in one of my videos, which are found on MarketScope Advisor, the 3 R's: retreat, rally, retest. So I don't think that we have gone through a successful retest of the March 23rd low yet. I think that might be something we will have to contend with.
Thanks, Sam. And Stu, the CEO of Exxon was on CNBC earlier today talking about the company's reduced CapEx, and the question is whether they can support its dividend either with funds or more borrowing, and how long can they do that given Exxon is kind of the blue chip in the energy sector?
Yeah, Ken, it's a good question. So for context, Exxon spends about $15 billion a year on dividends. Their CapEx budget had been, an expectation of $32 billion a year on spending on average between 2020 and 2021. They slashed their spending down to about $23 billion. So that's freeing up around $9 billion just this year that they can then allocate towards the dividend. I do think that if they needed to, and let's say they wanted to borrow all the funds needed for the dividend, $15 billion a year, and keep it flat for several years, I think they could probably do that for about 3 or 4 years before their net debt to cap ratios would get more in line with a typical E&P. A typical E&P is around a 35% net debt to cap ratio. Exxon, by contrast, as you said, the blue chip in the industry is more like 11%. So they do have a fair amount of wiggle room to play with borrowing if they had to.
Great. Todd, ETFs, great way to be investing and trading. And when you look at March, where were the outflows and where were they going? And importantly, given the long tenure you have covered ETFs, did the markets work? Was there any breakdown in terms of ETFs, in terms of execution as well? So outflows as well as market execution.
Yeah, so let me take the first part in terms of outflows. We did see outflows, I think in some cases for the right reason, and in some cases for somewhat surprising reasons. For the right reasons, we did see investors using the market volatility as an opportunity to rebalance. So Vanguard saw inflows into VOO, which is their S&P 500 equity ETF, and they saw outflows into BND, which is their aggregate bond index. So if you were rotating to rebalance and get you closer back to your goal of 60-40 or 50-50, you'd want to take some of the profits on a relative basis from your fixed income and into equities. We also saw outflows to some of the cash-like actively managed ultra short ETFs like MINT from PIMCO. We've done webinars on that, and JPST, which is a JP Morgan ETF. These were positioned to be relatively safe products. I think we found investors rotating into even safer, into treasury-based products as opposed to ones that have some corporate bond exposure. I would have expected investors to be going towards these cash-like securities more than they did, but the market is a real time as opposed to just based on what people would expect. What we did see, however, and I didn't have in my slides, was that ETFs, specifically bond ETFs, were trading for a period of time at discounts to net asset value. So an ETF has a price that you would buy and sell it at, and then net asset value, which is the value of the securities of the portfolio, whereas a mutual fund just has a net asset value. Because the credit markets dried up during March, we saw that the net asset value held relatively steady in a declining market, and the price, which is real time, was falling. And that's probably closer to reality as to what buyers and sellers would meet. And then we found a couple of days later, they would come closer together, more because the net asset value reflected more the reality than beforehand. And we've also seen that the Federal Reserve has stepped in, offering to not only buy underlying bonds, but actually buy bond ETFs, have the exposure to do that. And that's helped to cause some equilibrium to take place. We don't think, in short, that this was an ETF problem. This was the underlying credit markets drying up and investors getting as close to a fair price as they possibly could. But there was a dislocation that took place for about a week or so during March.
Sam, in your presentation, you spoke about recession might be deeper and wider, and we didn't use in this presentation whether recovery could be V-shaped, U-shape, or L-shape, but we're talking about the S&P 500 in the market. When could we get back to our all-time highs, which were in February 19th? Today, it feels like a hypothetical question, but ultimately, when could this market get back to where we were?
Well, Ken, this bear market shaved 34% off of the S&P 500's high that was set on February 19th. Looking at all bear markets going back to World War II, any bear market that shaved 30% or more took a minimum of 18 months to get back to break even. So from that perspective, you could say, well, don't expect to get back to a new all-time high for a year and a half. However, this bear market is unlike any other. It took us only 22 calendar days to go from the peak on February 19th to the 20% decline threshold, which was more than twice as fast as we saw in 1987. And if the March 23rd low does indeed end up being the low for this bear market, it will have occurred almost 3 times as quickly as the bottom was set in the next fastest bear market bottom. So with that, what I'm hedging is by saying, that's why I'm sticking with our 34, 35 target for a year from now. Maybe we do end up acting more like a garden variety bear market, something that happened in the 20% area where we can get back to break even in maybe 9 months or so.
That's great. And Stu, your presentation really was driven by fundamentals. And if we begin to look at geopolitics and here in the U.S., first of all, any quick take in terms of the Saudis and Russia as it relates to oil prices? And then I'll throw in President Trump. Could he impose tariffs to support oil prices? And does that make sense?
Yeah, so let me take the first question on Saudi and Russia. It's hard to read the tea leaves with those folks. I would say that Saudi Arabia made a mistake by trying to corner Russia, and you just don't poke the bear and expect that Russia is going to do what you think it's going to do. I would say that both parties are probably looking for some kind of face-saving maneuver to cut production without looking like they completely messed up by walking away from the table the first time. I would expect that, we're starting to hear about emergency meetings as a meeting planned for Thursday. I am a little pessimistic that this is going to happen short term. I think it's more likely that you're going to get some kind of agreed upon cut maybe by the June meeting. But keep in mind that, the reason that Saudi Arabia and Russia walked away was they couldn't agree on a cut of 1.5 million barrels a day. And the kind of cuts that President Trump is talking about to avoid tariffs would be like 10 times that level. So if they had a hard time with 1.5, it's going to be very hard to get them to agree on 15. Now, when it comes to tariffs, I think there's an assumption that's built into what President Trump is saying that, well, since the U.S. is now a net energy exporter, why don't we just, use all of our own oil and not have to deal with, foreign countries for oil? The problem with that view is that oil is not entirely fungible. There are different qualities of crude oil, and the way that refineries are built, they depend to a fairly decent degree on the kinds of oil that are not coming from U.S. reserves. So you need Canadian heavy oil, you need Mexican heavy oil, you still need a fair bit of crude oil from overseas, and while it's less than it had been, it remains a need. And so if you do impose tariffs, you're going to eventually push prices up at the pump, and the refiners who do depend on foreign oil are going to suffer.
Todd, a quick take in terms of, in the last 2 months, the launch of our CFRA's methodology and the market volatility. Any examples of ETFs where you saw big swings or changes that occurred?
So as mentioned earlier, we use machine learning techniques and we update our ETF ratings on a monthly basis. And so what we saw was in ETFs that were or some of the ETFs that were higher quality focused. So an ETF like Invesco's SPHQ, which is a high quality portion of the S&P 500 index, it received a new 5-star rating in the month of, or as we kicked off the month of April. Part of that is the analysts covering some of the underlying securities like Pepsi and Coca-Cola became more positive on those stocks, and thus that helped drive the valuation assessments of the securities inside, and partially because the machine learning techniques saw the market becoming more volatile, used what worked during other times when we saw corrections in the last 5 years to see what was working. So SPHQ is an example of something that went up. Vanguard's Information Technology ETF, VGT, is an example of a ETF that had a 5-star in the month of March, and that rating went down to a 3-star in the month of April, again, in part because of the market volatility and the securities inside. We found the ETF to be riskier as we looked forward over the next 9 months than we did a month back. So we don't change our rating. We refresh the ratings on a monthly basis. Not everything will change. In fact, most things will not change. But we've got a particularly volatile market. Our analysts and the underlying ETFs behind these securities are going to respond to that.
Sam, last question, quick take. What are investors to do if companies are removing earnings guidance going forward?
Well, I think that's a definite possibility, not because they're trying to hide anything, but simply because they want to be as transparent as possible and say, look, we really just don't know. So I would actually say, first off, if you're an income-oriented investor, you might want to take a look at the S&P Dow Jones website, spdji.com, to look for those companies that are called dividend aristocrats. S&P 500 dividend aristocrats are companies that have increased their dividends in each of the last 25 years at a minimum. A list of companies in large, mid, and small cap universes that have consistent track records of raising dividends can also be found on the ProShares website, proshares.com, because they have the 500 dividend aristocrats, 400 dividend aristocrats, and the Russell 2000 small cap dividend masters. So looking for consistency, take that one step further. If you're looking for earnings and dividend growth, remember that I showed the S&P Global Market Intelligence, their quality ranking, A-, A+. Those are all above average, superior track records of raising earnings and dividends in the past 10 years. So if they can't give you guidance going forward, then maybe at least you can take some solace by looking at the consistency with which a company has either raised earnings and dividends or just dividends.
Moving to our final remarks and to the next slide, I also want to thank Sam, Stu, and Todd for excellent insights about their areas of coverage and expertise. You can see here to learn more, certainly for our next webinar, which will be April 16th, CFRA and Global X, Understanding the Growing Demand for Thematic ETFs. Back to Todd again on that. We are profiling on our landing page on MarketScope Advisor, Sam's videos and strategy, which is regularly published, along with the thematic spotlight on coronavirus from our analytical team. To get more information about MarketScope Advisor, you can go to www.cfraresearch.com. Next slide, please. We are offering to those on the call today and investors an opportunity to have access to CFRA research through a complimentary 90-day access to our weekly online newsletter called The Outlook. It's a great way to get different areas of research, as you can see here, related to weekly notes from our investment policy committee, also our thematic research, and it's really a terrific piece for those who are more general investors. Of course, MarketScope Advisor is our platform, which we strongly encourage for you to take a look at. And with that, we want to thank you for your precious time today to be on this call, and have a good day. Thank you.